Now adjust the volume control so that the sound can be heard in all parts of the room.
This is the Protect Your Assets podcast.
You get the idea?
It's on the internet.
Make him the cutest that I've ever seen.
Go on.
Give him two lips like
It's like no cheese I've ever tasted.
tell him that his love
Here's the Sandman.
over Sandman.
We celebrate 250 years since the Declaration of Independence. It's a chance to pause and appreciate the freedoms and opportunities that so many before us fought for, sacrificed for, and entrusted to us. America is the greatest place on earth to build something. An idea can become a business can become a career can support a family, and a family can shape generations. Americans serve their communities, defend freedom, invent new ideas, take enormous risks, overcome impossible odds, and leave things hopefully a little better than they found them. And none of that does happen by accident. It happens because extraordinary people choose to do extraordinary things. They show up, they work hard, they honor their commitments, they took pride in what they built, and they believe tomorrow would be better than today. That's the American dream. And we're not just a company supporting people here at the Liberty Group. As you enjoy this Independence Day weekend, I hope you take time to unplug, relax, laugh with family, friends, watch some fireworks, fire up the barbecue, laugh more than usual. Tell someone you're grateful for them and simply appreciate how fortunate we are to live in the most incredible country in the world. I want to thank everybody who listens to the show, who supports the Liberty Group. We've been helping customers for over 20 years now. So we just want to thank everybody and appreciate you, have you appreciate this holiday. And remember, life moves fast. Don't miss the moments that matter. Happy Independence Day, everybody. Today's show, we're going to talk about financial independence and freedom to do what you want to do. And how do you do that? Good morning. Welcome to Protect Your Assets. I'm David Hollander, your host. People around here, well, you heard the jingle at the start. They call me the Sandman. That's because I help my listeners sleep well at night. By answering their most troubled legal, financial, tax questions, we help you protect more of what you work so hard for. And that's because we have a financial service, tax planning, and law firm where we specialize in estate planning. You can always email me a question too. If something comes up you want to know what I might think, send me an email, questions@pyaradio. Again, questions@pyaradio.com. So happy 4th of July. Can you believe it's the 4th of July? And as I think about this holiday, and I just mentioned at the beginning how lucky we are to enjoy where we live and to enjoy this beautiful area, particularly on a day like today. But today is also about your freedom to retire. What do I mean by that? Well, just the other day I was speaking to one of our clients, Mark. Now, this experience that I'm talking about right now reflects a client's experience. This client was not compensated for sharing this that I'm about to talk to you about, and the experience is not representative of all clients, and results are not guaranteed and could vary based on your circumstances. But Mark shared with us that he was spending about $7,000 a month right now, and he wanted to start traveling with his wife to celebrate all their hard years of work together, raising a family, working, you understand. Mark wanted to know if he could spend an extra $2,000 a month to start to do those things in retirement, in addition to paying all his normal bills. After looking at everything, I said, yes, you can. See the plan right here? You have plenty of room. In fact, you could spend $5,000 more a month if you wanted to. And he sort of stepped back and said, what? Really? Yes. Let's put that into your budget. So this exercise with Mark got me thinking, and yes, it is the 4th of July, and we are celebrating our freedom as Americans today. But how great is it that this year Mark will celebrate another day of freedom from having to work another day in his life if he doesn't want to. And guess what? He doesn't want to. So making the decision to finally retire, it's exciting. And it will be a change in your life for sure. But while this is an exciting time in your life, it can also be stressful, because many people are haunted by the question that anyone retiring today asks themselves, particularly after a year like this so far, and that is, have they saved enough? Do they have enough money? And how will they turn that into income that will last the rest of their or their spouse's lives? With uncertainty right now at all-time highs, a market that feels like something's about to happen, and a world full of surprises, running out of money in retirement, it's legitimate. That's why today we put together a checklist that you can get right now to get ready for retirement. We'll be happy to share that with you. Call 866-PROTECT. We'll shoot that over to you. But we're going to talk about that today. I have created for you a show of freedom, and it'll be all about that. So it's all coming up next. Stick around. Let's get started. We had a good week in the market as the second quarter wrapped up. We're entering the third quarter now of the year. In the second half of the year, the Dow was up 2% this week. Year to date, up 10.1%. That's that broadening out I was talking about last week. You have the S&P 500 up 1.8%. Year to date, we're up 9.3%. NASDAQ up 2.1%. The big winner, though, still is the Russell 2000. It was off a little bit this week, but still year to date up over 20%. And the MSCI International Index up 1.6% for the week, year to date up 13%. 10-year Treasury held flat at $4.49, and oil finally got below $70 a barrel, 68.78 a barrel. So heading into the second half of the year, we're going to keep our eye on three things. First, labor, oil prices, and of course interest rates and what the Fed is going to do. So let's start out with labor. We just had the June jobs report just came out Thursday, and that was because Friday was a holiday. And the jobs number came in at 57,000. Expectation was 113,000, so that didn't sound so great. But we saw the unemployment rate finally go down a little bit to 4.2%. And in addition to that, we had wages up 3.5% year over year, and this was right in line with expectations. And so since those haven't moved much higher this year, that's keeping core inflation pretty much contained. More broadly on the jobs front, we also seen job gains in 26 so far this year. It's outpaced the job growth we saw last year. So on average, monthly job gains in the U.S. this year have been about 92,000 versus an average of about 9,700 last year. So way better. The steady labor market and pickup in job gains is supportive of households growing and consumption. And that's solid for a U.S. labor economy, which in our view supports the growth that we could see for the rest of this year, maybe 1.5% to 2%. So that labor, keep your eye on that. Hopefully still keeps expanding, still looks strong. Oil prices, and when will that price at the pump start to come down? Well, of course, the U.S. and Iran continue to make some progress toward negotiations, albeit no definitive peace agreement has been achieved. But nonetheless, traffic through the Strait of Hormuz has picked up, and markets continue to appear optimistic on the path of oil prices, especially as global economics focus on supply and strength. And as a result, we finally saw oil come down below $70 a barrel. And of course, these were levels that we saw prior to the war. But I think gas prices at the pump, well, they haven't fallen yet. And that's because there's a lag. And this is because gas stations, they buy all that oil at a price, and they have to work through that higher priced inventory before we'll feel the lower prices at the pump. And the third would be the Fed and interest rates. Well, as you remember, the Fed just met. This was the June FOMC meeting, and now we have the new Fed chair, Kevin Warsh. And he said that bringing inflation down was a priority for the Fed. And in addition, while there was a unanimous vote to keep interest rates steady at the June meeting, the committee seems split on the direction of rates for the rest of 26. In fact, 9 members indicated it was appropriate to raise rates 1 or 2 times for the remainder of the year, and the other 9 members felt it was right to keep rates steady or flat, maybe even cut once this year. Coming up next, What's going to be your largest expense in retirement? If you want to get ready to be free for your retirement, you need to understand these things. When I come back, we'll get into it. You're listening to the Protect Your Assets show. I am David Hollander. We'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now, back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known around here as the Sandman, and you are listening this morning to Protect Your Assets, and it is the 4th of July. We're celebrating 250 years, and we're celebrating freedom, your freedom to retire. But in order to retire, you need to know a few things. So before the break, we were talking about one of the biggest expenses you're going to deal with in retirement. And today, a 65-year-old couple retiring in the next decade was projected to need $345,000 for lifetime health care premiums alone, according to Fidelity. Now, this figure is up over 10% from last year. Talk about inflation. This number also doesn't account for the cost of long-term care. So what are these expenses and what do you need to know? Well, first of all, turning 65 and retiring, you're going to need to consider Medicare and what other options you might have. When you get close to age 65, you want to spend some time reviewing and considering all your Medicare options. When you do become eligible at age 65, you'll want to remember to sign up during your 7-month initial enrollment period. This begins 3 months before the month you turn 65. And there is a lot to learn about the world of Medicare, and I'm not going to be able to cover the whole thing this morning. So if you want to learn more, we did a show just on Medicare. You can go to where you get your favorite podcast, type in Protect Your Assets, Medicare, and you should find our Medicare show. But in any event, we'll highlight some of the things you need to know now. So you need to know about Medicare Part A, Part B, and there's something called Part D. Now, there's something else you need to know about it, the Medicare Advantage, and also something called Medigap, which is a supplemental insurance plan. In brief, here we go. Part A covers your hospital costs after you meet a deductible. Part B, it's an optional coverage for medical expenses and requires annual premiums that you have to pay. If you didn't get Part B when you first were eligible for Medicare, your monthly premium could go up 10% for each 12-month period you could have had Part B but didn't sign up. In most cases, you'll have to pay a penalty each time you pay your premium for as long as you have Part B. Moreover, the penalty increases the longer you go without Part B coverage. Part D is for prescription drug coverage. Medicare Advantage plans are all-in-one managed care plans that provide the services covered under Part A and Part B of Medicare and may also cover other services that are not covered under your Part A and B, including Part D prescription drug coverage. Supplemental policies, those are referred to as Medigap policies, while they're offered by private insurance companies like Blue Cross Blue Shield. And these supplement expenses that Medicare Part A does not typically cover. Here's a tip. You may be better off paying a higher premium, but not having to pay out of pocket at your office visits. Look at the cost of annual premiums and copays at different levels of supplemental insurance, and make sure you compare these costs annually Then factor in how many visits and copay, coinsurance per visit that you anticipate for the upcoming year. And realize that once you are retired, you're probably going to access some of these things more than you did when you were busy running around going to work. Once you select a Medicare plan, it is not forever, and you can switch Medicare plans as you age and as your situation changes. Generally, it makes sense to enroll in Medicare Part A, B, and D when you are first eligible because the late enrollment penalties, as I just talked about a minute ago, are steep. For example, you may owe a late enrollment penalty if you go without Part D or other creditable prescription drug coverage for any period of 63 days or more in a row after your initial enrollment period. So think about this. If you're going to continue to work, let's say you're 65 and you're going to still continue to work and possibly you're covered by your work plan, well, you might want to consider just going ahead and getting your Medicare anyways and looking at some sort of a supplemental plan that wouldn't be very expensive at all, in fact, and would get you the ability to avoid some of these penalties. If you're still working when you're 65 and you get health insurance through your employer or maybe even your spouse's employer, you'll have the opportunity to enroll in Medicare when you leave your employer plan through a special enrollment period. In addition to Medicare options to consider, if your spouse or partner continues to work, they may be able to cover you through their health plan. So talk to your HR department to help you evaluate all your options, your costs, and any restrictions. The rules of Medicare, they are complicated, so get started and consider the following questions. You may want to write these down. Which plan offers you the best coverage for your health needs? How about this? Your employer is required to offer you coverage, but is that your best option? Is it more expensive to stay in your employer plan or join Medicare? Can your spouse or partner remain in your employer's plan if you decide to leave? Here's an idea. Remember, one of the key goals at this stage is to avoid any gap in coverage. You want to make sure that you are covered. Healthcare and retirement costs can come later. Well, as you plan for healthcare expenses throughout your retirement, however long that might be, understand how paying for future healthcare expenses, how will that fit into your overall retirement budget? Because healthcare tends to increase as we age. As I just mentioned, that study came out from Fidelity. It was 10% higher than it was a year ago. Although healthcare costs continue to rise, there are financial planning steps that you can take today to help prevent healthcare costs from eating into your retirement lifestyle. For example, if you're age 50 or older, you may be able to make up for a savings shortfall with additional catch-up contributions to your 401k or HSA plan. In addition, if you are age 55 or older, you can make additional $1,000 catch-up contributions annually to that health savings account. So these are some different things that you can do as you consider aging and retirement. And remember, one of the big costs that you're going to experience in retirement, most likely, especially if you're healthy and married, will be long-term care. And again, we did an entire show on long-term care and the 5 things you need to know about that. We're going to cover a little bit about that here in the next segment. But if you're thinking about retiring right now, maybe you want to retire, but you just don't know how to do it. It just seems too complex. Granted, you've been saving in your 401k. Maybe you have a high concentration of your company's stock. Values are at all-time highs. Is this a good time for you to retire? Well, it very well could be. This is something that is our latest when it comes to retirement. It's called the Retirement Checklist. We'll email that out to you this morning. It's a free copy. All you have to do is call us right now, 866-PROTECT. That's the number to call to get this handout right now. Pick up the phone, dial this number, 866-776-8328. Again, 866-776-8328. We'll go ahead and email this right out to you. It's going to take 2 to 3 minutes just to read through it, but you're going to see some really good ideas that maybe you didn't know existed. 866-PROTECT. Coming up next, you guessed it, it's time for our popular They Say segment, where they say long-term care, well, it's only going to last about 2.5 years if you need it. Is that really true? Find out. We'll be right back.
Take the first step toward reaching your financial goals and get the information that can help you live a confident retirement. That first step is going to pyaevents.com and signing up for our next free event. That's pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets. And today is the 4th of July, and we are celebrating freedom, your freedom to retire. But before you do that, you certainly need to know what's coming your way. And so this morning we're covering some of the big expenses that you will be facing, most likely, as you enter a different time of your life. Now it's time for one of our fan favorite parts of the show. This is our They Say segment, where we debunk common myths, half-truths, and just sometimes bad advice that they say.
Who are they? What do they know that I don't? And what are they saying this week? Here's David Hollander, the Sandman's answer.
All I know is that I don't know.
All right, so here's one they say. In fact, I hear this one all the time. They say that the average long-term care stay that you're going to need is about 2.5 years. Is that true? Well, the first thing you should say is when you hear that, you should say, well, are you talking about men or women? Right? And that's a good question. And most people would think, well, women most likely would need longer care stay than men because they live longer, right? I mean, those are sort of the way you put that together. Well, I've got some statistics for you. And of course, this is amazing when you look at this. This is from AALTCI. This is an organization that looks at long-term care. Look at the longest claim. Do you think it's male or female? Well, you're wrong. It's male. It's the longest male claim for long-term care that was filed. This is a long-term care insurance claim. 19 years and 3 months. Can you believe that? Can you imagine 19 years of care? The longest female one that's reported here was 18 years and 1 month. So again, not too far behind, but still, the male went the longest here. Incredible. So with that in mind, most people would say, well, heck, I don't want it to go that long. But you got to consider this. What could be the average cost of something like this if you were facing this in your family? And so right now, as we look at estimates, costs of care, just statistics out there, consider this. When you think about long-term care being 2.5 years, potentially, if that is a good statistic, $203,364 for about 2.5 years of care for whether you're a man or a woman. And if both of you were to need that, you could be looking at over $400,000 of care. Now, what about out in the future? Because again, if you're in your 60s right now or your late 50s, you're thinking about retiring, you easily could go another 20 to 30 years. And so that's when I was talking last segment about just the cost of healthcare and what that would run. And then let's just say at the end of that, you needed some sort of long-term care, just one of you. It could be, just one spouse who needed the care. Of course, you'll probably go into your savings and you'll figure out what's the best way to get that. And for those of you right now who are listening to this, I'm going to go ahead and give you a copy of my book. This is the Protect Your Assets book. And in it, I have on page 79, an entire chapter divided to how you pay for care. These are all my ideas and options on how you pay for long-term care. I'm going to go ahead and give that to you now. Call 866-PROTECT. You can ask for the Protect Your Assets book. They will email that over to you, 866-PROTECT. In there, I talk about the ways to pay for care and how you could do that. And get this, the most expensive type of care you could be looking at. And by the way, there's so much research on this, and it's just an interesting topic to get into, particularly if you have a family history of dementia or Alzheimer's. You'd be surprised how common this is. Unfortunately, I see this regularly in what we do. And, an average Alzheimer's stay, that could be 8 years. I mean, think about that. 8 years of care at a very high level. And if you inflation that and go out 20 years from now, if that were to be you could be looking at $1.6 million. Think about that, $1.6 million of money you would need to take care of yourself in a facility. Well, you may say, well, the kids could just sell the house and just pay for it that way. Sure. I mean, that is a plan. That's one way to do it. But there are other ways you can do it. And so if you're not educated on the subject, again, get a copy of my book, Protect Your Assets. It is on Amazon. David Hollander is my name. I'm the author. Get a copy of that book and look into this subject, because it is something that could be very, very expensive. Now, what's another subject you need to know about? Because remember, we're talking about your financial freedom, your ability to retire. Social Security. Literally weekly, we go over this with our clients. We have a module in our financial planning software that actually breaks down Social Security, looks at all the new rules, any changes that occurred in Congress, and how do you take out the most from Social Security when you consider your RMDs and your pensions, your rents, any other income you have. Coming up next, how do you increase your chances of success in retirement? Find out when I come back. You are listening to Protect Your Assets with David Hollander. That's me. We'll be right back.
Times are changing. Some would say they've already changed. And how do you actually protect your assets? David Hollander's Protect Your Assets events focus on common financial concerns that individuals and families face in retirement. Things like how to prepare for unexpected medical expenses and ways to create income to help support your desired lifestyle. Join us at our next free event to learn how addressing these concerns can help you feel more confident about the days ahead and help you sleep better at night. Just go to pyaevents.com and reserve your seat today. That's pyaevents.com and sign up or join the wait list today. pyaevents.com. Now back to Protect Your Assets with David Hollander, the Sandman.
Welcome back. I am David Hollander, also known as the Sandman, and you are listening to Protect Your Assets, and it is the 4th of July, and we're celebrating freedom today. Your freedom to retire. Today we've been going through the things you need to consider, and one of the main things you can do to increase your chances of success in retirement is to consider these three things. First of all, these three things can help increase your success or probability when it comes to retirement. First, which we were talking about last segment, had something to do with Social Security. Now, every one of you have something known as the FRA, the full retirement age. First of all, you need to find out what that is, and just by waiting till your full retirement age, you can increase the success of probability in retirement. I was also talking about at the end of the last segment how you optimize your Social Security. This is, again, using tools that are available today to figure out what's the best way to strategize to get your Social Security. Now, if you do that, your success probability ratio goes just by optimizing Social Security. The next part of all this, you use the Social Security optimization, plus you start to look at ways to change your portfolio so it focuses on three things instead of one. Think about it this way. You've been working, putting money away in your 401k. That's mainly been looking at growth. But now I want you to change your mindset a little bit, because as you enter retirement, you're going to need to think about income. How do you generate income? And then next, safety, because you can't lose all of it anymore because you can't go back to work. And then, of course, you need some growth in there to keep pace with inflation. So it's thinking about the three prongs of retirement: income, safety, and growth. And then add to that portfolio optimization. What do I mean by that? Well, maybe you build a bond ladder of municipal bonds as opposed to taxable bonds. Then there's things called annuities. Annuities provide guaranteed income life products that are backed by the claims paying ability of those insurance companies, where you develop an income strategy that would pay out for as long as you live. That way you take the mortality risk off the table. You may have life insurance products that could convert into income. You want to look at your exchange traded funds, any mutual funds you have. Start to consider long-term care insurance, as we talked about earlier. These are all great things that you should start to consider as you analyze your portfolio and how it's going to do the things you're going to need it to do when it comes to your retirement. Give us a call right now and we're going to shoot you our retirement checklist. 866-776-8328. Again, 866-776-8328 to get your retirement ready checklist. I'd like to give a big thanks to the Protect Your Assets team for putting together a great show today. My executive producer, network manager, Kevin Renfer, and of course, my fabulous producers back there answering the phone, Raph, Zach, Nick, because without my team, I'm just another pretty voice on the radio. Thanks again, everybody. You've been listening to the Protect Your Assets show. I am David Hollander, the Sandman. Go out and make the rest of your life the best of your life.
Investment advisory services are offered through Liberty Wealth Management, a registered investment advisor. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. The strategies mentioned are not suitable for everyone. The information expressed does not consider your specific situation or objectives and may not be appropriate for all investors. Past performance is not indicative of future results. To better understand the risk associated with investing and how it reacts to different market conditions, listeners should always consult with their qualified investment professionals, financial advisors, legal or tax specialists, and conduct their due diligence before making any financial decisions or taking any action. The legal information provided on the air is not intended to substitute for callers hiring their lawyers to advise them about personal legal matters. Investments involve risk and, unless otherwise stated, are not guaranteed. Liberty Group LLC paid for the following program, and the host's views and opinions do not represent those of the station or its ownership. California Life Agent number 048569. Persons engaging the services of one affiliate of Liberty Group LLC companies should be aware that each company is operated separately. You are listening to the Protect Your Assets Radio Network.